Now, there are three biggest retirement enemies. Number one, taxes. The required minimum distributions are going to hit if you don't continue to take money out at a certain age from that retirement account. You're always going to have that ordinary income on the withdrawals from a 401k, IRA. And again, there's going to be future tax uncertainty of whatever the government wants to put into the bill and start charging us, the American people, again. Number two is market volatility. Market can downturn early in those retirement years when we start to get into retirement, and that can truly destroy this longevity that we can use this money to live off of. And it really forces retirees to sell assets at the worst time. But then number three is the lack of control. This money is going to be locked into those types of accounts with rules, with penalties, and with age restrictions. And a lot of you retirees, you depend on these advisors, the market, and government policy, and that's not control, in my opinion. You need to get in control of those types of accounts. Hello, Money Multipliers. Welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? Welcome back, another week here talking about money, wealth building, and how to become our own bankers. If you're new here, I upload every Tuesday to the YouTube channel and also on all podcasting platforms, the Money Multiplier podcast. And hey, if you want to, come and join me live every Thursday, 9 a.m. Eastern time. I go live on all of my social media channels, YouTube, LinkedIn, Instagram, Facebook. So if you go and search my name, Hannah, spelled the same way as forwards and backwards, Hannah Kessler, Kessler with one S, you'll find me on there. So hit subscribe, hit the follow button, and then you'll get notified every Thursday morning when I go live. And it's a lot of fun. I mean, people are asking me questions in the chat box. I take those questions live and answer them live. And we get into various topics week after week. So come and join us there. And also, if you can't join us in the morning time, maybe you're over on the West Coast, it's going to be 6 a.m. your time, and you're still sleeping, like myself. I like to get up around like the 7 a.m. hour. That's like my preferred time to get up, like 7 to 7:30. So if you don't hear us live, you can also find the Money Morning Show as a podcast if you search up Money Mornings with Hannah Kessler. So we have a great topic to get into, and this is a topic we're also going to be talking about coming up in Tampa at the Money Game Live event. If you go to moneygamelive.com, you can see all of the speakers and different topics that we're going to be getting into. But how can I retire without having market failure, fear, or even panic when it comes to my retirement accounts? Because think about it, the masses and what we're taught to do is go work our jobs, take some of that money and go and place it into 401ks, IRAs, Roths, self-directed, HSA accounts. And we are taught to take that money and put it into those various accounts so that in the future, we can live off of this money. Now, given if you're an IBC vet over here, you've probably tuned into one of the most recent episodes where I talk about cash accumulation versus cash flow. But let's get into this very basic understanding about money. Money, and the definition of money, is it's nothing more than just a means of exchange. We exchange our money for goods, products, services, investments all day long. Money is nothing more than just a means of exchange. And it mind boggles me a little bit because people will do things with their money that they would never do with things that money buys. I am never going to go buy myself a car or a house and then wait until I'm 59 and a half years old. In my retirement account, you have to wait till 59 and a half just to avoid the 10% penalty. So I'm not going to go buy myself a car or a house and then wait until I'm age 59 and a half just to move into the house or drive that car. It's kind of ridiculous sitting here at 26 years old. That's going to take me 34 and a half years into the future just to drive the car and move into the house. It's kind of ridiculous when I put it in that perspective. Or another even perspective, because people like to hoard their cash, if you will. Now, given I do understand it is important to have a cash reserve set aside somewhere for the rainy days, the rainy funds, the emergency dollars. But if you are just taking all of your money and just setting it somewhere to sit stagnant, you're not moving that money to the best use for yourself. Because if we're not making more money with those dollars that we do have, we're losing our purchasing power on that money because of that hidden tax called inflation. So I am not going to tie my dollars up into those other accounts where, number one, who's in control of that account? Is it you or somebody else? It's someone else, and there's no guarantees in those accounts. Well, there's one guarantee. It's guaranteed to never go below zero, but how fun and exciting would that be if that actually happened? And then all you really know about your retirement account is if it goes up and down based on the quarterly statements that you get. You know whether that account is invested in a low, moderate, or high risk category. But other than that, y'all don't know jack crap about your retirement accounts. Somebody else is controlling it. You're giving up your good dollars today to get paid back with non-guaranteed weaker dollars in the future. And then you're just kicking the can down the street on the taxes that you have to pay on that money when you do want to take it out. Now, I know we're sitting here at the start of 2026, and I do have an update of the 2026 tax brackets. I'm going to post it up here on the screen so you can just get in the know of what's going on our tax situation and tax side of things. But even if I do keep that money in those retirement accounts, I'm still going to have to pay tax on that money. Now, given I know some of those other accounts like the Roth and other things, no, we don't. But more so the traditional side of those retirement accounts, I'm going to be taxed on that money when I withdraw the money out of those accounts. And all of your financial advisors, when they're coming to you talking about those retirement accounts, they're telling you, hey, it's okay. Take those tax breaks today, because in the future, when you start to withdraw from this account, you won't be making as much money in the future. So it's okay. You won't be taxed as much in the future when you want to go and withdraw that money out. And me, in my simple mind over here, given I know I'm at a 26-year-old perspective, but I talk to a lot of people in my day that have these types of accounts who actually need the money now. They need the money for debt payoff. They need it because they have sick family member that they need to go and take care of. They need the dollars because their car is breaking down. It's on their last leg and it's unsafe to even drive the car to take them to work to even make money and income for themselves. So I know a lot of people who will stick dollars away into those types of retirement accounts who actually need the money, and your financial advisor is telling you, hey, go and stick this money away, take your tax break now, because in the future you won't be making as much money, and it's okay because then you won't be getting taxed as much. To me, my goal, and when I start to look at my financial life every single month, honestly, because I update my net worth statement every month, go back and watch that one episode, how to scale policies without overextending yourself. I walk through my personal net worth statement on there. But when I'm looking at my stats every month, I'm thinking to myself, how can I continue to create more cash flow and more income and revenue each and every month each year? Now, maybe I'm not making more money, but yet I don't want to be making any less money than what I am right now, because as we know, Parkinson's law, once was a luxury is now a necessity. Once you start getting used to the Netflix subscriptions, the no ads on YouTube subscriptions, the gym memberships, the yoga classes, y'all, I was so close to signing myself up for a monthly subscription to Hand and Stone, the massage place around here in Daytona Beach. $80 a month, you get a massage once a month if you want to. And it's a membership. And I get their business perspective on it. It's a great business model. But I'm like, Hannah, do you really need to sign yourself up for $80 a month to go get yourself a massage every month? You're not even home half the time. Come on, girlfriend. So a lot of the dollars that we have locked up in those accounts, we could be using that money today, but given too, when I'm getting into my later stages of my life, into those retirement ages, I'm probably gonna keep the same expenses that I have now, and if not, it's probably gonna increase because now I have more time on my hands. I'm able to go and join more clubs, give back to my communities, and I'm gonna want that money so that I can go and fund and do these things that I want to do in my life. I mean, that's all the purpose of money is just to allow us to buy the things that we want to purchase for ourselves in our life, right? So what if retirement didn't have to feel like this gambling on the market or guessing what this tax bill will be? Because the reality of it is that a lot of the retirees, y'all fear market crashes because you're getting to that end stage. Now is the time when this qualified account is supposed to be here for me. And if something happens within the market and it crashes, that's not good for me. I don't have that time continued on that I can go and continue to work. I know of somebody, 2020 happened. She calls me up. She's a really great client. She calls me up. They got about 6 policies with us over here at the Money Multiplier. And she says, Hannah, I should have listened to you from the get-go because of COVID and what happened to the market. My 401k just dropped over $100,000. And I think about that still to this day because I'm like, what if she wasn't in her late 40s? What if she was getting into late 60s, 70s, even late 70s? And what if she needed that money to go and retire off of? So market crashes are a big concern to a lot of the retirees. And on top of that, as I mentioned, the tax bombs that come in from 401ks and IRAs when you want to go and withdraw the money out. And more importantly, I'm going to do a whole episode on this coming out this month as well, in the month of February. But running out of money, are you afraid that you're going to outlive your money? Later on in this month, I'm going to do a whole episode on how to not outlive your money and the statistics of how many people are fearful that they will outlive their money. But it is a big concern because if I'm going to store my capital inside of a place for retirement, I'm going to want to have certain attributes to that account. I want to have control. I want to have liquidity. And me personally, I am trying to minimize my taxes as much as I possibly can. And I truly want to have tax-free income. So is it possible that I could actually have tax-free income? The answer is yes, and stay tuned. I'm going to walk through some policy illustrations. I'm going to show you how to craft this up for yourself. But most of the retirement plans, they're built on this hope. Well, I hope that the market's going to be cooperative with me. I hope that tax rates are going to continue to stay low. And I hope that these withdrawals aren't going to hurt too much in my tax bracket for myself. So the sequence of the return risk, pulling out this money during the down markets, it's scary, y'all. It's a little scary when you start to give out that control to somebody else. And matter of fact, have you ever noticed that the only time that you actually lose money is when you give that control to somebody else? Isn't that kind of funny? Just take a little perspective on it. So these tax deferred accounts, and people always shouting at you, take the tax hits now, take them now, take them now. Those tax deferred accounts do not equal tax free. And the lack of this liquidity truly creates this panic that people have when they're thinking about retirement. Now, there are three biggest retirement enemies. Number one, taxes. The required minimum distributions are going to hit if you don't continue to take money out at a certain age from that retirement account. You're always going to have that ordinary income on the withdrawals from a 401k, IRA. And again, there's going to be future tax uncertainty of whatever the government wants to put into the bill and start charging us, the American people, again. So number one is taxes. That's a big enemy when it comes to these retirement accounts. Number two is market volatility. Market can downturn early in those retirement years when we start to get into retirement, and that can truly destroy this longevity that we can use this money to live off of. And it really forces retirees to sell assets at the worst time, if you think about it. I don't want people going into retirement thinking, hey, I got to take out a reverse mortgage, or I need to start pulling the equity out of my house, or selling my jewelry or precious metals because I need this money just to put food on my table. That's not really sexy, if you ask me. But then number three is the lack of control. This money is going to be locked into those types of accounts with rules, with penalties, and with age restrictions. And a lot of you retirees, you depend on these advisors, the market, and government policy. And that's not control, in my opinion. You need to get in control of those types of accounts. And here's really why these traditional retirement accounts, in this advice, it falls short. Quote unquote, max out your 401k. This creates future tax problems. Now, I will say, even like my younger brother, he has a great 401k at where he works at. I mean, they're matching their employees 60% inside of that 401k account. And some people have come up to me and say, well, Hannah, he could put in that money as a match into that 401k, and then later on he could convert it to a Roth if he wanted to. Okay, yeah, he could, but who's in control of those accounts again, right? I want to be in control. Quote unquote, ride out the market. Well, riding out the market really doesn't work when you're starting to get in those later stages and you need to start withdrawing that money because you're now 70 years old. You see what I'm saying? Or quote unquote, just save some more. This ignores the cash flow realities. If I'm already breaking even at the end of the month, hopefully not negative, you got some more issues there if you're negative in the red every month, but just saving some more is not feasible for everybody. And most of those plans focus on the accumulation, not the distribution or the cash flow. You see what I'm saying? This is why for me personally, my retirement plan, I have my 8 policies. I'm using the cash values in my policies to buy my investments. And right now, just been doing this 20 years old. Now I'm 26. 20 years old, sorry, let me back that up. Started my first policy when I was 18, got into real estate investing when I was 20 years old. So from 20 to 26, just investing the cash values from my policy has allowed me to create $10,000 a month of passive income to myself. So if I just do nothing else but continue to do the same investments that I'm doing right now through my policies, I'm going to have a guaranteed income of $120,000 a year. Plus, I can start taking out tax-free income from my policies, and I could use that to supplement my income during those retirement years. And why I like my policy is to go back to the 3 enemies. 1, taxes. inside of my policy, my cash grows tax-free. I'm putting in after-tax money into the policy, and now the growth is tax-free. So everything that I take out of it in a policy loan will be tax-free to me, and I can even withdraw from the policy tax-free up to my cost basis. Cost basis meaning how much have I put into that policy over the course of its lifetime. If I put in $400,000 as premium into that policy over its lifetime, I can withdraw tax-free $400,000. And then guess what happens? If I get to that point where I'm withdrawing up to my cost basis tax-free and I still want more of that money, I'm just going to switch it and now start taking out policy loans for myself. So it solves my problem for the taxes. Number two, market volatility. It has nothing to do with the markets. Inside of that policy contract, it's guaranteed. You have a guaranteed interest rate that the insurance company has to pay us every single year. I'm not even going to talk about the dividends, but the dividends are the extra bonus on top of that. And the insurance companies that I personally hold my policies with, do business with, they've been paying out dividends for over 124 plus consecutive years. So I get those dividends too, tax-free, might I add. But just looking at the guaranteed interest alone, it's a policy contract, and they are contractually guaranteeing me that interest that they have to pay me. So has nothing to do with the markets. And number three, control. Me being the policy owner, I have 100% rights and control over that contract and over the cash value that's inside of my policy. So I am checking off already the three enemies that we have. I can totally avoid those by redirecting that money into a properly structured whole life insurance policy with the mutually owned company that pays dividends. And inside of this properly structured policy, when I make those deposits, my premium deposits into it, I have that cash value there. I can take it out whenever I want for whatever I want. May I go back and repeat myself? Whenever I want for whatever I want. So it also solves my problem that if I need to take care of a sick family member, if I need to go buy myself a new car because mine's on my last leg, buy new tires for my car, if I'm struggling with the tax bill, ding, 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 that's what's going on in Hannah's life right now. But if I need that money right now, I have access to those dollars and I don't have to get permission to access that cash account and the money that's sitting over there. So I just don't know why more people don't do this. I mean, honestly, sometimes it irks me. Dad says it all the time. Dad's like, if people truly knew the power of whole life insurance and what you could do inside of a overfunded, properly structured life insurance contract, there would be a line right up out the door waiting to get in, waiting to get some. So that's why I'm here creating these podcast episodes, doing my Thursday morning show, because if I'm not here doing this, who else is going to be educating the public on this powerful stuff? And y'all, I'm going to go back when I'm in my later stages, let's say 60 years old, I'm going to come back to some of these episodes and say, wow, Hannah, just look at where you're at. And I would love to, 40 years into the future, I come back here and I say, okay, here's what I'm doing now. This is how I'm supplementing my income with my policies. This is how I've been using it for my investments. I got the cash flow from the investments. This is how much I'm bringing in every month. And this is what I could withdraw tax-free from my policies to live off of. So there's just a lot of benefits in these policies, and I really want y'all just to get this stuff. Seriously, think for yourself, keep questioning, go do your due diligence, go do your research. But I am able to have tax-free income, protect myself from the market or others, even bankruptcies, lawsuits, judgments, liens, just putting it out there, and then also having that liquidity and control. So I'm going to pop over to my teaching board, and I want to show you an example of depositing in $5,000 a year into a policy, and kind of compare that to if I started to contribute $5,000 to a 401k, and I'm going to be fair, using, let's say, a 4% match from my employer. Where am I going to be at when I do want to start taking out this money come the time of retirement? So let's pop over to the whiteboard. Hey, money multipliers, pardon the interruption, just really quick. I want to get real with y'all. If you've been carrying around this weight of your financial life by yourself alone, the stress, the confusion, that feeling that you should be farther ahead than where you're at right now, you don't got to keep doing things the hard way. Money Game Live in Tampa, this is a space where people come to finally break free, to rewrite their money story, to stop surviving and start building the life they know that they're meant for. And I'm telling you that something powerful happens when you get into a room of people who are done playing small, who are ready to take back control of their future. You see what's possible. You get the clarity. You meet the people who have done it and been there before. And then you start to feel the hope again. But Tampa is just a couple of months away. It's coming up very, very close, and seats are disappearing. So if this is something that's been kind of whispering to you, hey, I need this, listen to that gut feeling. So go snag your tickets, moneygamelive.com, and give your chance just to breathe again, to grow, and just to believe in yourself. So this is going to be your breakthrough moment, and all you got to do is just show up. And as my yoga teacher always says, showing up is 50% of the work. I will see all of you money multipliers in Tampa. Now that we're over here at my whiteboard, I love this little thing. I need to use it more and more. When I'm home, she'll be making an appearance on the YouTube channel. So if you are still listening to this on audio form, I would encourage y'all to hop over to the YouTube channel, but I'm going to do my best to describe it over voice as well. But behind me, this is a policy illustration. I pulled Vivi's policy, Chris Nagel's daughter, when she started her first policy. And I wanted to do an apples to apples comparison of $5,000 a year into a policy versus $5,000 a year into a retirement account. Now, in this first example, I'm not doing any matches. The company's not giving me any matches in this account because obviously with my policy, I'm not getting matches over there. The only match I kind of get is just that dividend, the extra bonus that I receive. This example gets into how Vivi can be using this policy through her life. She can fund for her college education, her wedding, her first down payment on the house, yada, 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 right? So she's able to continue to use the policy as she goes through life and can finance for those different transactions. On my screen over here, let's just start on the left-hand side. We have age, all the way down, starting at 1 year old. You have premium, the $5,000 a year premium going in. You have the accumulative premium column. How much have I put in total into the policy? Projected cash value, net cash value, we'll get into that. Oops. Net cash value, retirement cash flow. That is the column that we're really gonna look at. Then my cash flow for retirement, that's cumulative cash flow is the cash flow that I've taken out of the policy using this thing to finance the things in life. We won't totally talk about that here today. And then I have my death benefit and then net death benefit. Net death benefit, just real quick. When we're taking out policy loans, or even if we withdraw the money out, we are using the cash value, which is a prepayment of our death benefit. So we're essentially just using the death benefit money early and while we're living. If I were to have a $1 million death benefit and I've been using the cash values from my policy and I've taken out $600,000 of loans over the course of my lifetime, at the end of it, when I pass away, I graduate, whatever that outstanding loan amount is, the insurance company will take my death benefit, the $1 million, subtract that $600 that I've already taken out, I did not pay back. So that remaining $400,000 would get paid out lump sum tax-free to whoever I listed as the beneficiaries on my policies. So in that example, I said policy loans. Same happens for the withdrawals. The only difference when it comes to withdrawals is I'm no longer being charged my policy loan interest because I'm physically taking the money out. So given I'm no longer earning interest or dividends on that money because I withdrew it out. And then I am surrendering part of my death benefit too. So my death benefit is literally going down because I'm withdrawing that money out. And then obviously, hey, I can take out, excuse me, computer, it's reminding me about my next meeting. But I can withdraw tax-free up to that cost basis, up to my cumulative premium that I put into the policy. So let's just scroll down. Let's just get into our retirement ages. In my retirement years, I'm going to start taking out distributions at the time that I'm 64 years old. So from year 1 to 64, I've been paying premiums inside of this policy $5,000 a year. And then at age 65, you'll notice that the premium actually drops from $5,000 down to $3,000. Why does it drop? Because those paid up addition riders are dropping off. So really this policy and how it's built, $3,000 to the base and $2,000 to those paid up additions. It's built as a 60 base, 40 PUA policy here. So at age 64, I have my cumulative cash value, $1,945,000. That's what I can take from this policy. Now, when I was comparing it to a 401k account, I actually come out on top inside of my policies compared to the 401k just on the cash alone. Because comparing the example of starting my $5,000 of premium in a policy compared to starting $5,000 in a 401k, no match going through the same period of time, those 64 years, I'm going to have more money within inside of my policies than what I am sitting inside of my 401k account. So number one, which one would I rather have? More money? Maybe so. If I start here taking out $90,000 for the next 35 years, from age 64 to age 99, I would have taken out a total of $3,150,000 of cash flow from this policy. If I went with that retirement account on the 401k, I have 1.7 million. No ifs, ands, or buts. Yes, the market can go up. I can get more gains within that policy that year, within that retirement account that year, but it's all based on markets. I'm not in control of it. In my policies, I am in control of this. So with me just taking out this 3.1 million of cash flow, if you will, to supplement my income, I want to do a total snapshot of everything that happens. And I'm only going to go until age 90. At age 90, my total premiums paid into this policy is $398,000. Yes, I do agree. You're probably thinking to yourself, well, Hannah, once I leave that employer, I'm no longer putting money inside of this 401k maybe, whereas my policy, I am still continuing to pay money into it. That gets into, yes, if you really wanted to, you could stop paying premiums into your policy, but get yourself into the mindset that your policy, it's the place of where you warehouse the money at. Just as if you warehouse your money at somebody else's bank, Bank of America, Wells Fargo, US Bank, you're just now making your deposits and warehousing your money in your bank. And have you made too many deposits into your own banking system? Hopefully the answer is no. I am continuing to make these premiums into it compared to the 401k, like I mentioned. So my total premiums paid is $398,000. Total loans that I've taken out is 2.7 million and some change. My cumulative cash value is 5.5. And after doing all of this, I know I'm just highlighting retirement right now, but even if Vivi were to take this to fund her education, her kids' education, down payments on houses, weddings for her kids, all of that money that I've taken out, I still have a net cash value of 2.9 million. So all in all, my total net returns here is a 738% growth simply by just using the cash that's happening within inside of my policy. I don't think there's anything dumb or ridiculous that I'm doing here. It's just me funneling cash through this policy, and now I'm just using it for one specific way of how I can use this money to now live off of without needing to ask permission to take this money out, because it's rightfully my money. Would you agree? After all of this, if Vivi were to pass away at age 90, that net death benefit minus the loans that she's taken out and has not paid back would be $4 million. So now when Vivi passes, she's given away her $4 million of death benefit to her beneficiaries, but then also she's able to give them those cash flowing assets that the policy bought her over the course of her life. Obviously, I do still have it continuing to go on till age 99, and if she does and is still here at that time, she can still use that money. And you notice that the death benefit continues to grow along with the cash values each and every year. Here is how you can retire using the policies actually. You're gonna fund these policy premiums during your working years. You're gonna earn uninterrupted compounding on the cash value so that in retirement, I can borrow against this policy for income while the cash value keeps increasing if I do continue to still take out those loans. And again, the loans don't have to be paid back if you don't want to. It's just netted against your death benefit. So it really creates this personal pension-like stream and system that you get to control, and you don't have to rely on other people to create this pension stream, guaranteed tax-free income for yourself. Doing my retirement this way, it takes the emotions out of it, and I'm able to truly be peaceful and have that peace of mind that my money's gonna be there when I need it. I'm not fearful that I'm checking the market. There's no fear tied to tax hikes or running out of money. It's me having this freedom to do this confidently that it becomes more of a lifestyle than what it does just say, set it and forget it retirement account. I wanna ask y'all, where will your retirement income come from? How much of it is going to be taxed? And on top of that, what happens if markets drop by 30%? I don't want y'all just to go through life and have this blind trust in other people, your advisors, the government. You really need to take control of what you can control. If you want to get deeper into this, you want to see exactly how retirement is going to pan out for you. Maybe you have other accounts that you just want a second pair of eyes and third-party perspective on it. I'm here. I'm your girl. Send me an email, hannah@themoneymultiplier.com. I'll give you my feedback, okay? I'll turn you on to what I'm doing, what's working out for me over here, how I am producing cash flow, and then also a guaranteed side that I can have this retirement now living and breathing for me, if you will. And the goal truly isn't to retire rich. Yes, I want to be wealthy. I want to have money, but it's more so retirement should be predictable. it should be tax efficient and it should be peaceful for you, but it all starts with the control and you're in the driver's seat. So it's up to you to continue on with the education, with the questions that you want answered. And I'll close it out on this. This is what Pops always says. He says, the wealth train is going to keep on moving down the tracks, and it's your responsibility to be at the station, show up, and hop on. Ain't no one else going to be doing it for you. So be at the station, hop on, and if not, the wealth train's going to keep on moving down the tracks with or without you. It's your responsibility whether you want to take that control or if you want to give it up to other people, taxes, government, inflation, market volatility. The list keeps going on. All right, I hope this was beneficial. I will even link this as a handout if y'all do want to have a copy of Vivi's policy and how she's using it for funding through her life and then also retirement. Send me an email. Again, it's hannah@themoneymultiplier.com. I want to be here to help and support y'all, okay? So let me know if you want to hop on a one-on-one. And reminder, check out the presentation. If it's been a little bit, head over to themoneymultiplier.com/presentation and we get deeper over there as well. All right, until next week, I will see you then. And for all of you people joining me this coming Thursday, I'll see you on Money Mornings with Hannah. Until next time, be well, do great, and I'll see you soon. Bye, y'all. Hey y'all, thanks for tuning in to today's episode. If this podcast made you rethink money, the next video over here is going to change how you use and apply this method. So click the videos here to continue your education, and I'll see you next week.